Two people apply for the same mortgage on the same house on the same day. Same income, same down payment, same down to the cent on every other detail. One has a credit score of 750, the other has an 810. Over the life of the 30-year mortgage, the second person will pay about $50,000 less in interest, $50,000, for the exact same loan. The difference between those two scores isn't years of work. For most people, it's about 90 days of specific, learnable moves. By the end of this video, you'll have all 5 of those moves: the statement date trick that boosts your score by 20 points overnight, and the credit score myths that quietly hurt people while sounding like good advice. But first, what an 800-plus credit score actually unlocks beyond the mortgage. A credit score above 800 is not just a slightly better mortgage rate, it's a different financial life. You qualify for the absolute best credit card sign-up bonuses and rewards programs. You get the lowest auto loan rates available, often 2 to 3 percentage points below what someone with a 750 pays. You get instant approval on premium credit cards with concierge service and travel benefits. You get higher credit limits, which themselves help your utilization ratio, which feeds back into a higher score. Landlords approve you faster and with less hassle. Some employers in finance even pull credit as part of background checks. Cumulatively, over a lifetime, the gap between a 750 and an 810 is 6 figures of interest, fees, and missed rewards. The push from one to the other is one of the highest dollar-per-hour activities in personal finance. Your FICO credit score is calculated from 5 specific factors with specific weights. Payment history is 35%, the single biggest factor. Credit utilization, how much of your available credit you're using, is 30%. Length of credit history is 15%. Credit mix, the variety of account types, is 10%, and new credit inquiries are 10%. If you know these percentages, you know exactly which moves matter and which don't. Most people spend energy on the wrong factors. They obsess over closing old cards, which actually hurts them. They ignore utilization, which is the fastest moving lever. They worry about hard inquiries, which are minor. The 5 moves we're about to cover map directly to the 4 biggest factors. Master these and the score follows. Credit utilization is the percentage of your available credit you're currently using. If you have a $10,000 credit limit and a $3,000 balance, your utilization is 30%. This single number can swing your credit score by 50 to 80 points faster than anything else. The targets that matter? Under 30% for an OK score, under 10% for an excellent score, under 3% for an elite score. The fast move is to either pay down balances right before the statement closes, or to request a credit limit increase on your existing cards, which mathematically drops your utilization without you paying down anything. A simple credit limit increase request on each of your existing cards can move your score by 20 to 40 points within 60 days, costs you nothing, and takes about 10 minutes per card. The average age of your credit accounts is one of the biggest factors in your score. This means the single worst thing you can do is close an old credit card you don't use anymore. Closing it removes its age from the calculation entirely and immediately shortens your average. It also removes that card's credit limit from your total available credit, which spikes your utilization on everything else you still owe. Keep old cards open. Put a single small recurring charge on them, a streaming subscription, a phone bill, pay it automatically, and otherwise ignore them. They quietly age in the background, boosting your score every year they stay open. The oldest card you have is one of your most valuable financial assets, even if you never use it. Don't throw it away by closing it. Here's a move most people don't know exists. If you have a family member with a long, clean credit history, ask them to add you as an authorized user on one of their oldest cards. When they do, you get added to that card's credit history. Not just future payments going forward, but the entire history of that card back to the day they opened it. If they have a 20-year-old card with a perfect payment record, your credit file suddenly shows 20 years of perfect payments. This can move someone's score from the low 600s into the 700s, or someone in the 700s into the 800s almost overnight. The authorized user doesn't have to use the card or even have access to it. The benefit is the history inheritance. Done within a family, this is normal, legal, and intended by the credit system to work this way. Credit mix is 10% of your score, and most people overlook it. Lenders want to see that you've successfully handled different types of credit: a credit card, an installment loan like a car payment or student loan, possibly a mortgage. If your entire credit history consists of only credit cards, you're missing some points by not having proven you can handle other credit types. This isn't a reason to take out loans you don't need. But if you naturally have a mortgage, a car loan, and credit cards in your life, that mix is helping your score without you doing anything. If you only have credit cards and you're trying to push to an elite score, taking out a small credit builder loan from a credit union and paying it on schedule for 12 months can quietly add several points to your score. Not always worth the effort, but worth knowing the lever exists. A hard inquiry is what happens when a lender pulls your credit to make a lending decision. A new credit card application, a new car loan application, a new mortgage. Each hard inquiry drops your score by about 5 points, and the effect lasts roughly 12 to 24 months. 5 points isn't catastrophic, but 6 hard inquiries in a year is. People who chase every credit card sign-up bonus and apply for 5 new cards a year are quietly trashing their average score even while accumulating rewards. The discipline move is to space new credit applications at least 6 months apart, ideally a year. Need a mortgage soon? Stop applying for new credit entirely for at least 12 months before applying for the mortgage. This single discipline often saves people from rate denials they don't see coming. Here's a quiet move that can boost your score in a single month. Your credit utilization is reported based on the balance on your card the day your statement closes, not the day you pay it. If you charge $2,000 on a card and pay it off before the statement closes, the credit bureaus see a zero balance. They never know you used $2,000. Your reported utilization is zero. Even people who pay in full every month report whatever balance was on the card at statement date, sometimes 30% of their limit. The trick: pay your card down to under 3% of its limit a few days before the statement closes, even though it's not due yet. Your reported utilization drops dramatically, and your score reflects it within 60 days. This single move has pushed scores up by 20 to 30 points overnight for some people. 3 credit score myths cost people points constantly. Myth 1: closing a card you don't use cleans up your credit. Wrong. It shortens your average age and spikes your utilization. Keep it open. Myth 2: carrying a small balance on a card builds credit better than paying in full. Wrong. Carrying the balance just costs you interest. The credit bureaus see the usage of credit, not the balance, as long as you pay on time. Always pay in full. Myth 3: checking your own credit score hurts your score. Wrong. Pulling your own credit is a soft inquiry and has zero effect on your score. Check it monthly through the major bureaus or any free service. The myths are loud and confident. The math is simple. Pay in full, never close, watch utilization. Here's the actual 90-day plan to push your score significantly. Day 1, pull your credit reports from all 3 major bureaus. Dispute any errors. Wrong addresses, accounts you don't recognize, late payments that weren't actually late. Errors are common and they hurt your score until disputed. Day 1 to 30, request credit limit increases on every existing credit card. Day 15 to 45, set up automatic full balance payments on every card. Pay down to under 3% utilization on each. Day 30 to 90, get added as an authorized user on a long-standing family member's card. Day 60 to 90, keep utilization low, no new applications, watch the score climb. Most people running this plan see 20 to 50 point improvements within 90 days. Some see 70 or more if they had errors to dispute. Once your score crosses 800, the game changes. Lenders compete for you. The cheapest mortgage rate, the best auto loan rate, the premium credit card sign-up bonuses are all available. You should be using this leverage. Refinance any existing high-rate loan you have at your new score. Apply for the absolute best rewards card you've ever qualified for. Negotiate the rate on any loan you're carrying. High scores have negotiating power. And then maintain it boringly forever by paying in full, never closing old cards, watching utilization, and spacing new applications. The 800 is not a finish line. It's a lever you use, then maintain. Reminder: this is general education, not personalized credit or financial advice. So here's the whole thing in one breath. Your credit score is one of the highest leverage numbers in your financial life. The $30,000 mortgage gap in our cold open is real, and a 6-figure lifetime gap is realistic. Crush your utilization, never close old cards, get authorized user history if you can, keep some credit tech diversity, and discipline your new applications. Use the statement date trick, ignore the myths, run the 90-day plan. The push from a mid-700 score to an 800 plus is mostly mechanical once you know which moves matter. Do them once, maintain forever, and every loan you take for the rest of your life gets quietly cheaper. If this helped, subscribe. Thank you for watching, and see you in the next video.